This is Nightly Business Report with Tyler Matheson and Susie Guerin.
August ascent. The S&P 500 turns in its best monthly performance since February. But could September's jam-packed calendar send stocks in a different direction? The doctor is in at Wal-Mart. The world's largest retailer is making an aggressive push into primary care health services and could change the system as we know it. And Market Monitor, why small caps are the big shots in this market. We have all that and more tonight on Nightly Business Report for Friday, August 29th. Good evening, everyone. Tyler's off tonight. Forget about those dog days of summer on Wall Street. The major averages just wrapped up a blowout month of August, one of the best this year, capping 4 straight weeks of gains despite low trading volume, struggling economies in Europe, and deepening troubles in Ukraine and the Middle East. On this final trading day of the month, the Dow added almost 19 points, the Nasdaq rose 22, and the S&P up 6.5 points, closing at a new record of 2003. And by the way, tomorrow will be the 2000th calendar day since the bull market began on March 9th of 2009. And what a month August has been for Wall Street. The Dow is up more than 3%. The Nasdaq posted a gain of 4.8%, and the S&P higher by more than 3.5%. Only February posted higher gains for those big indexes. So why do the markets keep rising in spite of all the headline risks? And what are investors looking forward to in September? Bob Pisani takes a look.
Despite turmoil in the Mideast and Ukraine, the market remains in an uptrend. Now, why are stocks rising and what could derail the rally? First and most importantly, the market is up because of continuing low interest rates. Secondly, there's low commodity prices like oil. Third, there's a slowly improving economy. Fourth, we have record earnings. And finally, the U.S. is still the best place to put money. Next, what could derail the rally? Other than a significant global crisis, there's 2 red flags. First is a rapid rise in rates, like above expectation economic numbers or a change in the Fed outlook. Secondly, a significant profit margin deterioration. We're at record high profit margins right now, but higher commodity prices or higher labor costs could compress earnings. Corporations would have to raise prices then. That's very difficult right now. For now, barring a global crisis, most market watchers say the uptrend will likely continue. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Patricia Edwards believes the markets will go higher through the end of the year, and she just raised her target for the S&P 500 index to 2060. She's managing director of investments at U.S. Bank Wealth Management. Patty, that's a pretty bullish forecast. If you're right, that would mean that the S&P 500 for the whole year of 2014 would be up 11.5%. What's going to drive stocks according to your forecast?
Well, we think we're in a Goldilocks economy at this point. It's neither too hot nor too cold. We think that the Fed is still behind us in providing liquidity. And when you wrap all those things together, plus the earnings growth that we're seeing, which was 10.5% year over year, we're thinking that things are still going to continue to bumble along. Not, off to the races, but still continue to bumble along.
What do you do? How do you weigh in a headline like we saw today about that terror alert in the UK up against some good economic news? I mean, what goes through your investment strategy when you come in the morning?
Well, the headline out of the UK was certainly startling, but you can't plan for events that we just don't know are going to happen. And so you really have to look at the fundamentals underlying the market first and foremost. And if you look at the fundamentals, we're not overvalued. We do have the earnings growth. We do have strong cash on balance sheets. There's a lot of good things going on. And absent an absolute event, some sort of tragic event happening, you have to keep looking at those fundamentals in investing.
It sounds like you pretty much agree with the package that we just had with Bob Pisani in terms of what could derail the rally, right?
Yeah, we do. And, our target of 2060 is just through the end of the year. Right about this time of year, as everyone's coming back from the Hamptons, you start to look out toward the end of 2015, and that gives us even a little bit more wind in our sails, we think.
Let's talk about an even more near-term event on the calendar, September. I mean, people coming back and looking at their portfolios, and we know that historically September has been a very nasty month for the markets. So many people have been calling for a correction. Do you see like a 10% correction or more in the month of September? How feasible is that?
You know, anything can happen, and so we would not want to go on record and say there's absolutely no way. But that being said, you know, once again, it's the fundamentals. It's looking at the market loving to climb a wall of worry. People have been calling for a 10% correction for a lot of days now, and it hasn't happened yet. We think that you could actually go in and buy any of the dips, and we think that consumers will continue to do that. There's not a lot of money flowing into equity mutual funds. You know, we're not near a blow-off top, and we're only trading at 17 times this year's earnings. That's very normal given the amount of cash that is on the balance sheets.
Also next week, we have a lot of fresh economic data, including the jobs report. European central bankers are meeting on Thursday. We're going to have a lot of new information for investors to review. How will all of that play out in the market?
Well, certainly the numbers on employment are absolutely crucial, and we would like to see that number continue to be above 200,000 new jobs being added. That being said, what's going to push the consumer to spend more is not going to be new jobs, it's going to be greater income. And so that requires the economy to actually be picking up and requires more than just new jobs, it requires better jobs.
All right, Patty, thank you so much for coming on the program. Have a great weekend. Patricia Edwards at U.S. Bank Wealth Management. Well, speaking of spending, a bit of a setback for the economic recovery. Consumer spending in July fell for the first time in 6 months. Household spending fell 0.1% from the month before, with an unexpected dip in auto sales getting some of the blame for that decline. With consumers pulling back on spending last month, how did that impact retailer earnings? And what's the outlook for consumer spending for the rest of the year? Sarah Eisen reports.
Challenging. That was a commonly used word by executives in corporate America this earnings season when it came to describing the state of the U.S. consumer.
Given recent results in a challenging macroeconomic environment, we now expect that our full-year equity income will be down compared to last year and our original expectations for this year.
Low and middle-end consumers are continuing to struggle. They have changed their buying habits. While our customer always finds a way to work through difficult times, she is struggling to overcome the sustained nature of the headwinds she is facing. As we move through the second half of the year, we will begin to lap headwinds that have weighed on our core customer.
Even Macy's, which has been holding up better than most retailers, had this to say about the current state of spending. Our outlook for the fall season reflects our confident optimism, tempered by the reality that many consumers still are feeling the impact of an economic environment that at best is improving very gradually. The pessimism may help explain today's data, showing household spending dropped in July for the first time since January, calling into question whether the economy can sustain the post-winter momentum and growth.
While we continue to operate in a challenging environment, we're pleased that we were able to exceed both our earnings expectations coming into the quarter and prior year's earnings as we continue to manage expenses tightly.
Despite the gloom, there are some reasons to be optimistic going forward. Consumer confidence has been rising, in fact, at multi-year highs right now. The price of gasoline this Labor Day weekend, the cheapest since 2010, and generally comments from CEOs about back-to-school fall shopping season have been upbeat. It's going to be the key question facing the U.S. economy, 70% of which is dominated by consumer spending. For Nightly Business Report, I'm Sarah Eisen.
It doesn't look like consumers have been opening their wallets at Toys R Us. The nation's largest toy store chain posted a wider than expected loss in the just completed second quarter. Sales actually rose, but deep discounting took a big toll on the retailer's bottom line as it cleared out store shelves ahead of the big holiday shopping season. Low-income borrowers looking to buy a new home might be getting some help from Uncle Sam. The Federal Housing Finance Agency, which oversees Fannie Mae and Freddie Mac, wants the two firms to provide more support to struggling borrowers taking out mortgages and refinancing current loans. Well, some of those same low-income Americans can now turn to the nation's largest retailer for primary health care visits. Wal-Mart is testing in-store health clinics for the uninsured, charging a flat fee. Will it work? And will it force other providers to change the way they provide care and how much they charge? Bertha Coombs has the story.
Wal-Mart launched its newest health clinic with a marching band and fanfare. The retailer is looking to change the game in retail health, offering more services at a lower cost than its rivals.
Price matters to our customers and our associates. So the Wal-Mart Care Clinic is really about establishing that new price point.
At a time when more workers face higher out-of-pocket costs, Wal-Mart's clinics offer expanded services in stores, such as physicals and wellness checkups, face-to-face with nurse practitioners for a total of $40, far less than a typical doctor's visit. For its employees, it's just $4.
At $4 and $40, significant disruption in the industry.
While it's only a pilot program for now, analysts say if Wal-Mart can make this level of pricing work, it'll pose a big challenge not just to other retail clinics, but to other providers, doctors and hospitals.
They are a real opportunity, they are a real threat in many different places, and if providers don't respond accordingly, they could see many of their most profitable channels disrupted.
Wal-Mart is facing its own higher health costs as more of its associates are now enrolling in its health plan in the wake of the Affordable Care Act. That plays a big part in the retailer's clinic equation.
That's a pretty good way to handle that added enrollment and first-time health coverage consumers.
We take walk-ins.
And it doesn't hurt that once they're all in the clinics, they'll likely shop in the store. Bertha Coombs, Nightly Business Report, Carrollton, Georgia.
And you can read more about Wal-Mart's big push into primary care on our website, nbr.com. Still ahead on the program, what's the new way to get it to the head of the class in school? The smart money says high-tech tutoring. The U.S. Treasury Secretary will finally speak out about so-called corporate tax inversions. Jack Lew is planning a speech on September 8th where he could offer a hint to the administration's efforts to tackle the problem of American companies reincorporating overseas in order to avoid paying higher U.S. taxes. The corporate drone wars are heating up. Just weeks after Amazon announced plans to use unmanned aircraft to deliver goods, Google now says it's developing a drone system to deliver packages to customers, and it's testing them right now in Australia. A different kind of testing is just around the corner as millions of kids head back to school. That means a lot of parents are thinking about getting their children some extra tutoring help. And thanks to some high-tech new tools, that business is taking off. Julia Borston has our story.
Tutoring is a $7 billion annual business in the U.S. alone, and thanks to new technology virtually connecting students to tutors online, more students can access better customized help 24/7. Revolution Prep, with $15 million a year in online revenue, is growing at 75% a year.
We have a platform that is very similar to a Skype. It's two-way webcam. They have a shared whiteboard. The curriculum is embedded right there into the technologies.
Now, a range of internet and education giants are jumping into tech-enabled tutoring, making acquisitions and investments to bolster the sector that's poised for disruption. This summer, Barry Diller's IAC bought Princeton Review to combine with Tutor.com, which connects students to 3,000 tutors in 40 subjects. Digital textbook company Chegg bought online tutoring center Insta.edu for $30 million. Education publisher Pearson snapped up Tutor Vista, and Graham Holdings is pushing more of Kaplan's test prep tutoring business online. Meanwhile, startups ranging from Wyzant and Varsity Tutors tech platforms for finding in-person tutors to Revolution's online offerings are growing fast by offering the power of a personal connection.
1 to 2 hours per week of private tutoring on top of that can make a dramatic difference of a student being a 3.0 student to a student being a 4.0 student. So it's a great ROI.
And venture investors see the potential for technology to disrupt education. They poured over $420 million into 53 education startups in the first half of the year, on track to set a record for the sector. For Nightly Business Report, I'm Julia Borston in Los Angeles.
A lot of those students might be looking to get a new tablet computer this school year, and they'll have lots to choose from. That's one reason why research firm IDC just cut in half its outlook on global tablet sales growth this year to 6.5%, citing soft demand in Europe and here in the U.S. Apple is reportedly working on a system that could change the way you pay for everything from coffee to shoes. And that's where we begin tonight's Market Focus. The tech giant is collaborating with Dutch chipmaker NXP on technology to enable pay to touch in the next iPhone. This technology allows a smartphone to communicate wirelessly with other devices by tapping them together. Just yesterday, Apple announced an event scheduled for September 9th, where it's expected to reveal the new iPhone. Shares of Apple were up slightly to $102.50. That's a new record. NXP added 2% to $68.52. Big Lots reported earnings that came in better than expected as the company posted higher sales. But the discount retailer's revenue was below estimates, and the same was true for its same-store sales. The chain did raise the lower end of its yearly earnings forecast. Still, shares fell nearly 2% to $46.35. Some promising drug news lifted shares of AstraZeneca. The company moved a key immune disease treatment into mid-stage study, heightening hopes for its success. The drug is designed to help the body's immune system ward off tumors. The stock moved up more than 2% to $76. BioCryst Pharma also higher after it announced plans to initiate a study of its Ebola drug on primates, and it's received an additional $2.4 million in government funding for that test. Shares were up more than 2% to $13.50. Tesla and a Chinese phone carrier are teaming up to build 400 charging stations for electric cars in the Asian nation. The move is an effort to push sales in the world's biggest auto market. Tesla's shares closed at an all-time high today, $269.70, a gain of more than 2%. And $10 could buy you a piece of Kraft Foods. The company is offering up to 1.5 million shares of its stock as part of its new social stock plan. The food giant is partnering with Loyal 3 Securities, which allows investors to purchase fractional shares in the company. Kraft shares edged up a fraction to $58.85. Our Market Monitor guest tonight says this is the ideal time for investors to buy small cap stocks. He's Craig Hodges, co-portfolio manager of the Hodges Small Cap Fund, which is up 8% so far this year. Craig, nice to have you back on the program.
Thanks, Susie. Glad to be on.
Well, you know, you probably hear this all the time because you manage a small cap fund. So many strategists tell individual investors, put your money in large cap stocks. They're durable, they're safe, especially in times where it's uncertain. You're obviously doing pretty well with your small cap portfolio. Make the case about why investors should buy small caps.
You know, I think in a portfolio, everyone needs some small caps. You know, there's a lot of advantages to small caps. You know, the one thing is they're very entrepreneurial in nature. And, you know, sometimes our smaller companies are a lot more nimble. But the main things, you know, the main reasons that we like them is, you know, there's not that geopolitical risk that's out there that everyone's kind of a little bit afraid of right now. They also, you know, they also have a lot of advantages with just their size. It's easier to grow a company from $1 billion to $2 billion than it is one from 10 to 20. So, and the other thing is, in this very slow growth environment that we're in, you know, big companies need new growth avenues, and of course, by getting buyouts, buying small and mid-sized companies, larger companies can grow. Last year, we had about 6 companies out of our portfolio. The Hodges small cap portfolio bought out. This year, we've already had about 5. So there's a lot of reasons to own small caps.
You make a lot of good points. Let's look at some of the stocks that you're recommending that fit those data points. The first one on your list is Capstone Paper and Packaging. The ticker symbol is KS. It trades on the New York Stock Exchange at $30. Why do you like this particular one?
Well, Capstone's an interesting company. It's in the corrugated paper, and it's like a lot of the stocks in our portfolio. We love industries that have high barriers. There's not much competition. A lot of their competition has gone away. There's been a lot of consolidation in that industry, and no one's going to go out and build new virgin paper mills. It's just nobody wants that in their backyard. So with less competition, and when demand comes back and the economy comes back, you're going to see these guys' earnings go up pretty significantly, and their margins go up as well. So we think it's kind of a small name that's probably a good acquisition candidate out there. And so
it's trading at $30 now. Where do you see the target over the next year, year and a half?
I think next year or the year after next, they could earn around $3 a share. So on $3 earnings, the stock could trade in the mid-40s because it'll have at least that in growth rate. So it's got a lot of upside here.
Let's talk about your next one, Shoe Carnival, ticker symbol SCVL. It trades on the NASDAQ around $20. The stock has been falling recently, picking up a little bit as you see here, though. Tell us what the attraction is here.
It's a name we've been involved with for quite a while, and it's been a little bit disappointing. But they're getting to a stage. I filled up my car yesterday, and it's about $30 less to fill my car up than it was, say, a year ago. I think this fall everyone's going to have a little extra money in there, and so I think some of these very hated, unloved retail stocks have some opportunities. Real low expectations. Shoe Carnival is in the family shoe channel. They've got about 380 stores. We think they could take that to 700 stores over the next several years. But it's one that's been disappointing, trades at a low price, we feel like, and we think it's got probably 10, 12 points of upside over the next year and a half.
Okay. And the last one on your list, Matador Resources. This trades also on the NYSE. MTDR is the ticker symbol. It's trading at $27.
Yeah, Matador, great management. They're in the energy business. It's an E&P company, and they're in the Permian Basin and the Eagle Ford Shale, both in Texas. But this is a very well-run company that we think over the next several years is going to be able to make a really nice sum of money just from their expertise in this shale drilling. And as oil prices, I think, will continue to be elevated, they're making great rates of return on each one of these wells, and they've got several opportunities to continue to do well in this shale business. And I think it's an undiscovered company that's really underappreciated. And I think that it's the kind of company over 2 or 3 years could go up significantly.
All right. Well, a lot of these are off the beaten track. Really interesting list of stocks. Thank you so much, Craig. Craig Hodges with the Hodges Small Cap Fund. And coming up on the program, Playing Dirty is taking on a whole new meaning. We're going inside the big business and the big risks of Spartan races. That's coming up. And finally tonight, a new and very different type of sport is gaining popularity and a lot of interest from corporate sponsors. But as Morgan Brennan shows us, these grueling obstacle course races may be too tough for some athletes and a bit risky for some companies.
Now put your other hand here. There you go, see?
When participants sign up for a Spartan race, they face these obstacles, plus spear throwing and mud stretching on for miles, designed to push even the best athletes to their limit.
Spartan
Race is part of a growing fitness craze called obstacle course racing. It's now the fastest growing sport in the U.S., with more people participating in these races than marathons and half marathons combined. In 2009, an estimated 50,000 people crossed a finish line. Last year, 3 million.
I think it's primal. I think deep down inside, we're all wired to climb, crawl, run, swim. And now with social media, you can share that experience. So I think people get out of their cubicles, out of their house, off their couch. They do it, it feels great, they share it with friends, and it's gone globally viral.
The sport's explosive popularity has caught the attention of corporate sponsors and media giants. For Spartan Race, Reebok has become a title sponsor, and NBC Sports has begun broadcasting its races. And the sport's newly formed governing body is lobbying to get obstacle course racing made into an Olympic sport.
About 5 years ago, brands really weren't paying attention to this fitness space. And they've awoken to see that there are more than 4 million people that did color runs and mud runs last year. And this trend is continuing to grow. And so I think it's likely that we're going to see more and more brands enter this space.
Spartan's competitors in this space include Tough Mudder and Warrior Dash. All three are expanding rapidly and inking deals with sponsors. But it's not just the race companies capitalizing on this craze.
Cottage industries are being built around the sport. For instance, we created a shoe with Reebok. Certain kinds of ropes are being created, certain gyms are being created, all kinds of training equipment and gear and clothing are being created with companies like Reebok. And again, it shows that this is not a fad. This is here to stay.
But a number of risks face this fast-growing phenomenon. Injuries, even deaths, have been reported at some races, causing critics to call for better safety regulations. And some have questioned whether the sport is reaching saturation, as more companies pop up to cater to what might be a limited number of people willing to scale walls, flip tires, and climb ropes. For Nightly Business Report, I'm Morgan Brennan.
Looks like fun. That's Nightly Business Report for tonight. I'm Susie Garrett. Thanks so much for watching. Have a great weekend, and we'll see you back here on Monday for a special Labor Day broadcast. Susie Garrett with a Nightly Business Report news brief. Wall Street wrapped up a blowout month of August, capping 4 straight weeks of gains despite low trading volume, struggling economies in Europe, and deepening troubles in Ukraine and the Middle East. On this final trading day of the month, the Dow added almost 19 points, the Nasdaq rose 22, and the S&P up 6.5 points, closing at a new record of 2003. Federal housing regulators are looking to provide more help to low-income borrowers through Fannie Mae and Freddie Mac. Wal-Mart opened its first primary care health facility inside one of its stores, charging customers a flat $40 fee. And Google says it's developing a drone system to deliver packages, and it's testing them right now in Australia. Be sure to tune in to Nightly Business Report right here on your public television station.